Okay, thanks for tuning in to another episode of My Next Property. This is I'm really excited about this episode. I've got one of the good guys from property investing on the show, and he's been a long-term sort of mentor, great guy out there. I think everyone knows him. His name is Michael Xia. He's the founder of Mortgage Channel. He's got a massive portfolio, and he's also the mayor of Logan. So thanks for coming on the pod, Michael. Good to see you.
Thanks, Steve. Thanks for having me.
Yeah, no. I think I've been obviously sort of pestering you for a long time. You're a very busy man. There's a lot of clients, a lot of loans going on. I know you work 7 days a week and the portfolio is going really well. But I'm excited to have you on. I wanted to sort of spin it maybe a little bit differently today because I know you've been on a lot of shows and you did a good interview with Todd Sloan a few years ago on Pizza and Property. And I think that's really dug into your story a little bit. But what I wanted to do today was I'm going to talk about my own perspective, how I sort of came to find you and how it's been an inspiration to my journey. But for those maybe who might not know you, maybe it'd be good to know you a little bit and how things have gone and sort of how the portfolio is going. So how many properties we got now?
It's over 100.
Oh, yeah, I see you've broken the 100 mark.
Yes.
I didn't realize that. Okay, well, there you go. So what roughly sort of portfolio value is that then?
Be around about 100 mil.
100 mil?
Yeah.
Okay, all right. Yeah. So that's moved quickly. So, okay, so if I move back to 2015, I'm just going to talk about myself. This podcast is going to be about Michael Xia mostly and about how we can, people aspiring sort of investors and showing that a lot of it's mindset and a lot of it is following the fundamentals and how you can grow a portfolio. But when I went back, I started property investing in about 2008, 2009.
Yes.
I almost used Rolf Latham as my broker, but I was kind of weighing up between a guy called Richard Taylor and Rolf Latham.
Sure.
Rolf took a couple of weeks to come back. Richard came back in a couple of days. And then I went with Richard. I started on my journey, did quite well. And then I sort of, started messing around with development in Melbourne. And my portfolio value was about 2.53 million and was doing quite well with a fairly lowish LVR, but I was down in the dumps. And then my favorite part of the Somerset forum, which is a property chat forum, was the interviews. And I used to have a favorite one, which was a Spider-Man interview. But all of a sudden, there was this young chap called Michael Xia. And he came up, and then I read that interview, and I was pretty down about property investing at that time. And that really did give me a lease of life. And at that particular time, it was 11 properties, I think, going back. Or
it was 14. It was 14.
It was 14 properties.
Yeah.
Okay. But I think the thing about it was the simplicity of it, like your interview and how it was just looking at the numbers, looking at cash flow, and just rinse and repeat rather than trying to overcomplicate what I was doing. Is that a fair summation of how it was?
Yeah, I mean, if you kind of put myself in that position back in 2014, 15, I was still trying to figure out what to do.
Yeah.
But I think it just stumbled at the time in terms of what the markets were doing. And yes, it just so happened back then that in Brisbane, the numbers worked really, really well.
Yeah.
And it was boring. I just essentially did the same thing over and over and over.
Yeah.
And at that point in time, if you asked me in 2015 what they will look like in 2025, I would have told you to go away. There's no chance I could have guessed it.
10 years. Yeah. I mean, like across was it 12 properties, was it, in 2015 or 13?
Yeah, so it was 14 properties when I quit corporate in 2015.
And roughly the portfolio value then was around... I know I'm testing your memory here.
Probably about 3 to 4 mil, but don't quote me on that. Yeah,
3 to 4 mil. So kind of like the snowball, it was going down the mountain at that particular stage, and now it's turned into like, I don't know, something out of Indiana Jones now. Yeah, and really, so that's 10 years. That's remarkable, isn't it?
Correct. But I mean, in terms of the fundamentals of what I'm doing now compared to what I was doing then, it's all exactly the same.
Yeah.
Sure, maybe the location, the asset classes might be slightly different, but the theory and the approach and the mindset, it's all the same.
It's all the same. And roughly what is that? Like, I know it's deal economics, but I'm not going to put words in your mouth. Like, yeah, because property investing in general is boring. We hear it a lot. And if you want kind of, action, you've got Bitcoin, meme coins, whatever out there. But it really is, if the numbers stack up, you haven't been distracted by a lot of things. You've just kept it very simple, stupid. Is that?
Correct. I mean, if you ask me to kind of boil it down to some really, really simple key takeaways, I would say the first one is to go against the crowd. Yeah, being a contrarian. So if most people are buying, then I'll probably not so much selling, but be a little bit more careful on the market.
Yeah.
And if most people are selling, then that might be the best time to buy in.
Yeah.
And every single market I've bought in, I've always tried to take that where, say, for instance, from 2014, 2015 was buying Brisbane. And at the time, Brisbane was not having a great time. It was ever since 2009, the Brisbane floods, it pretty much went backwards.
Yeah.
And it was flat from 2015 all the way up until 2019, 2020. So for a good period of time, even I was questioning, what the hell am I doing? I still remember my own wife like saying from that period, it's like, stop buying, Logan. Don't you have enough?
Yeah. But when you look at it, I know you were very concentrated in your buying there. But when you look at the downside then, because you had decent cash flow and you're buying houses, like how much lower could they go? So was that kind of a thought process? Like the risk is pretty minimal here.
Sure. So that's a really good question on diversification because I always get it. Why don't I diversify? And if you look into other investors or people that have done really, really well, a common consensus is they just do not diversify because like say for instance, Warren Buffett, how many shares does he hold in his portfolio? Very few. And from every person I've worked with, be it a business owner or a very successful investor, the people that do really, really well do well by specializing. They find one thing and they do it really, really well, and then they rinse and repeat that.
Yeah.
And say, for instance, in terms of property investing, at a certain point in times, you're going to be forced to diversify. So, I mean, personally, I would love to buy in Logan, but I won't be buying at 700,000 when the rent's, below 5%. Right. So it's like, at that point in time, even if you wanted to buy more, you're going to be forced to diversify away.
Yeah.
But when the time is right and you can make hay, then just try to ride that for as long as you can. And similar thing happened in Perth. In 2021, when first started buying in Perth, you could buy a house there for $300,000. The rent was $400 per week. That was not too difficult.
No.
That same house now today is $700,000.
There you go.
So even if you wanted to buy in Perth, to a certain point, you're then priced out, then you'll move to another market. So eventually, if you follow the trend of the market cycle, you're going to be pushed to diversify.
Yeah.
But I wouldn't necessarily diversify for the sake of diversification. It's like I bought one in Logan. It's done really well. The numbers look great. I've got one in Logan. Maybe look elsewhere. I wouldn't do that if the numbers are still stacking up.
That's what I love about it. Like just at the top of the episode, just keeping it simple, stupid. If something's working, just keep doing it. If you found your edge, so to speak, and you're finding these deals, just keep pushing the button. Because I remember like looking at Somersoft into property chat. Oh, this is going to be the year of Brisbane. Oh, it's definitely going to be the year of Brisbane. You used to just like rinse and repeat going through the years till we got to 2019 and it was the year of Brisbane. But it was pretty hard because like the big mistake I made when I bought in Logan, we paid over the odds on those two and we had the two side by side where you could put units on, etc. They've done incredibly well now, but because I was paying probably about 150 above what you were paying at that particular time, the yields were maybe around that 4.5%, maybe a little bit lower. That really wasn't the Logan play. So you kind of hit that sort of, I mean, I'm just looking at the numbers here, like going back to 2015, going back in time, you had 84% LVR and your yield across those 14 properties was 7.3%. That's incredible.
Yeah. It was possible back then. It wasn't that difficult. Like you couldn't give away a house for $300,000 and then the rent was $400 per week.
Yeah.
And then also on that point of diversification, I find when you concentrate on a certain area, you get lots of economies of scale.
Yeah.
So now suddenly when you're negotiating with a property manager, it's not 6.6 or 7.7% property management fee.
Yeah.
You could get a bit of a discount.
Yeah.
And then because you're working with certain trades that are a little bit more, then you might find someone that you work well with. Then those become a little bit cheaper too.
Yeah.
And then on top of that, you build relationships with the real estate agents. Then instead of just getting on, market deals, average deals, then you might get a look in before it hits the market.
Yeah.
So all of these things, if you focus in on a certain area, then you get those economies of scale. And I remember precisely back then at that point in time, when a client will ask me, oh, where should I invest in Brisbane, or where do you think other people are buying, doing really, really well? My honest answer at that point in time was, I actually think Moreton Bay Council will do a little bit better.
Yeah.
But on the flip side, I was still buying in Logan. And the only reason for that is if I started from scratch and I had no contacts, no experience, I'll probably move to Moreton Bay. And, Moreton Bay, Strathpine, Bray Park, those areas have done amazingly well.
Killed it.
But on the flip side, I had no connections. I had no groundwork there. So that's why then I focused on Logan. It was only because I could beat the average punter in Logan a lot better than up north, where if I went up north, I will be starting from scratch and then trying to rebuild that network.
And going into Logan, obviously you became an expert. I mean, we've talked a lot about, like, it used to fly up every week, didn't you? And
every second week,
Every second week. So you actually knew the streets. And was it a case of like any deals, if the numbers stacked, was on the table in Logan, or were there some spots that you would definitely avoid?
Definitely areas that you avoid.
Yeah.
But like everyone knows, like if you think to where you live, the suburb that you live in, you would know the good pockets and the bad pockets.
Yeah, yeah.
If someone said, would you live in so-and-so and that's where you lived and you know that that's a rougher part of town, you'll be like, absolutely no. Whereas if you can get to that level of knowledge when it comes to buying in that property and for investing, that's how then you can then beat the average punter.
Yeah.
So say, for instance, there's suburbs in Logan, say, for instance, example of this will be Slacks Creek. Like Slacks Creek has 3 different pockets to it. There's one which is like the very sought after area of Slacks Creek. There's another pocket lower towards Kingston, which is really Kingston, not really Slacks Creek. But then people overpay a little bit more to be in that pocket. Then there's another segment which floods. So it just really comes down to knowing each of the suburbs to such a level of detail that you see that property, that street, and you're like, okay, this is what the true value should be.
Yeah.
And when you do get to that level, that's how then you can beat the market.
And that would be in your subconscious, I suppose. As soon as you look at a deal, you probably would know, like within 10 seconds, whether that's kind of, going to be the one with the numbers, etc., and where it is, etc. And that obviously helps. And obviously agents like speed.
Correct.
Quick decision makers, making it easy for them to transact, get their comm and move on. And that's a win-win situation, win for the seller, win for you, win for the agent. So
100%. And awesome.
Like,
if I theoretically got the same call from an agent up north, I would not have that level of confidence. Like in terms of if I was in Deception Bay, I would not begin to know what's a good pocket and then bad pocket. So therefore, it's a lot harder for me to make that decision.
Yeah.
Whereas say, for instance, in Logan, because you know it so well, just like you mentioned, 5 minutes over the phone, don't really even need to see the house. And then, approximately this is what it should be valued at. And then you can make a deal.
Make a call. Do you own any in Morrison Bay?
No.
I mean, do you own any in Ipswich?
No.
So it's purely, purely Logan.
And I mean, it could have turned out very differently too. If, in the beginning, I started off in a different council, I probably would have built it up there too.
Well, I think the interesting thing, and I kind of think I properly might, what they do, they move in cycles. And back in the day, and I think when you were starting out, you were kind of with me and we're looking, I mean, I used to get so excited about Western Sydney and Right Property Group, Nathan Birch, I don't mind naming names on the podcast, but I remember Nathan Birch pinning some sort of like deals out there in West Sydney. And I used to go out to Lethbridge Park every weekend. And, the numbers, I bought one and I'd tell the story at Goldman where I was looking at a property in Lethbridge Park. I'd already bought one in North St Mary's and they talked me out of it. And I thought these guys are a lot cleverer than me. And they're like, West Sydney never moves. And that's cost me, $1 million each property by parking there. But then the interesting thing talking about cycles is really what you did, because they're also looking around Newcastle at that particular time, but then obviously then Logan, it was really using that same sort of strategy over there. And then just once that had moved, then it was Perth. And so we're moving. And then once you've kind of found something like Greenfields in Perth, for example, I know you were kind of probably the first person there as well, and you milked that market. That's as easy. I mean, I don't want to go too off track, but I've got to ask you a couple of questions on this.
Yes.
One question, because obviously there's a lot of social media, a lot of us on podcasts talking about this and that now. I've got this theory where I think people are taking, the Logan examples and maybe what's happened in Perth and just taking it regionally, and people have done really well regionally, but I think it's apples and oranges what people are doing. What are your views on people going out to the likes of Townsville, buying these type of properties? Obviously there's money to be made, but to me that maybe they're artificially manipulated. Maybe, I don't want to put words in your mouth. This is kind of what I think, but interested to hear your views on it.
So again, I'm going to just bring it down to like really simple. At the end of the day, property investing and also in terms of demand for properties, it's just demand and supply. That's essentially all it is.
Yeah.
And for me, my gut feel and my comfort level is there'll be more demand in a capital city.
Yeah.
So, and I'm in this for the long run. I'm not looking for it for the next 12 months in terms of what the market will do.
Yeah.
My time horizon will be 20, 30, 40 years. I don't plan to sell any of these properties.
Yeah.
So in that case, if you ask me, if you fast forward another 20 years, what area will have more demand? Will it be a capital city or Townsville? Then that makes it pretty easy to answer.
Well, it's an easy answer then, isn't it? Because
Correct.
we've seen Townsville sometimes, it's gone through 20 years of no growth, essentially. So,
Correct.
So while you get that sugar hit, yeah.
And then also just in the last 5-8 years, it's been a very good period for regional. Partly because for a long period of time, it hadn't done anything. And I still remember when I first started looking into investing, if anyone mentioned they had a property in Cairns or in Townsville, you just felt sorry for them because they overpaid at the last cycle. They had to pay this massive insurance every single year and the property had absolutely done nothing.
No, yeah, 100%.
And then on the flip side of that, after COVID, a lot of these markets did really, really well. So some people go, oh, you know, the metro can't work, let me go regional. But the issue is, even on regional, you go back 4 or 5 years, a lot of these regional markets have doubled already. And they double from a very low base, so they still seem somewhat okay. But if you're saying in 2026, I mean, how much is a house in Townsville now? On a 600,
it's roughly 600, 700, I think.
For the similar price point, you could buy 650 in Melbourne.
Yeah.
So in the grand scheme, and not just putting into kind of which market will do well, but just the common sense cap on, Melbourne's a global city.
That's the world's most livable city about 5 years in a row, or whatever it was, but, you know, about 10 years ago.
You know, sure, at the moment, it's got its issues with crime, the government, after what's happened with COVID, but it's still 6 million people there.
Yeah. And it's projected to be 9 million, like 2040. Yeah.
Exactly. So you look at that and, you know, like what I also say is everywhere will have its time in the sun, everywhere, you know, so nothing's good forever and nothing's bad forever.
Yeah. Yeah.
So, you know, just like when you were buying in Perth in 2021, people used to laugh at you. You know, it's a mining town. This will never go up. Brisbane was the same. Back then, Brisbane people would say Sydney and Melbourne will only ever go up. Why would you invest in Brisbane? And the cycle will repeat. So at the moment now, people look at Melbourne going, hey, look, it's terrible. But in the grand scheme of things, if it's a similar price point and I had a choice between, I don't know what the population of Townsville is, but, you know, I'm guessing
210,000.
I mean, Melbourne's just so much bigger, just purely off that play. And the fact that Townsville has done 100% in the last couple of years, that makes my decision a little bit easier.
Yeah, no. And that actually leads quite nicely in the second question that I was going to ask. So obviously, we're looking at cycles, and obviously Perth has done incredibly well. And there was lots of great opportunity in 21 and 22. Now we look at kind of the next market for the cycle, and that is looking like Melbourne, where it's already started moving. It moved a lot quicker than I thought it was going to do. But here's the thing, I'm going to really put you on the spot in a few minutes, which I'm quite excited about because I'm a bit of a masochist. But with Melbourne, one of the big problems that I see with Melbourne, like obviously the prices are deflated, like you're talking about examples of 650 compared to sort of Townsville.
Yep.
But the problem here we get is yield.
Correct.
And so people need to be a little bit more creative, and we can't go to say Logan, for example, and use that cash flow type strategy. So any sort of, you know, opinions on how people might navigate that, or is it just kind of that's how it is at the moment if you want to get in? Yeah.
Okay. So in terms of that, I mean, take this with a grain of salt. It's just actually what I'm doing personally.
Yeah.
So, and recommend everyone to do their own research. So I feel that in terms of Melbourne, great capital growth play. I feel the market's moved a lot. If you're actually looking at the prices and seeing the contracts coming back, I feel the bottom of the Melbourne market was Australia Day last year. And since then, the prices have moved.
Yeah.
If you go back to that point last year, you probably could have got into Broadmeadows for about 550, maybe a little bit more. Now they're edging up to about 650, 700,000.
Yes, correct.
So, I mean, the market's moved a fair bit since then.
In Frankston, North Seaford,
it's done even better.
Same thing. Yeah, I mean, it is when you look at, you know, the last, even Melton, and you know, I'm on the fence about Melton, but even Melton's 600 now in a lot of suburbs, and that was 450 about this time last year.
Correct, and I'm not even talking about, you know, Metro Melbourne. You go a little bit further out, Geelong, where I've been really focused on. I've been buying Geelong myself too.
Yeah.
You could buy a house in Corio for 450 a year ago.
Yeah.
I mean, which now you think about it is insanely cheap.
Yeah.
And once the market started moving, literally in the space of 2 to 3 months, it went from 450 to about 550, 580. It just took off overnight.
Yeah, it is. And what we're seeing in the agency is people coming in, they want that sort of 550 price and they want that 5% yield. And it's like, well, you know, it just doesn't exist. And that, I mean, it didn't take long. There's almost like a light bulb switching from 2024 to November 24, December 24 to 25.
Yep.
All of a sudden, Frankston just jumped almost 100K. Broadmeadows jumped 50K. So I completely see what you're seeing. One of the markets in the West, like Werribee's the one that still kind of is the last one that does have a bit of value.
Yep.
And it's still in the doldrums a little bit, but it's moving quick. So
correct. Yeah. So to answer your original question there, one thing is I just look in terms of affordability. So some of the things that I also get in terms of when we do a pre-approval is, can we increase it a little bit more? Can we, push it up to 700, 800? But when I buy a property, I'm always trying to buy at the more affordable end. So if I can push the price down, why I say that is if you look at it in terms of the growth more so recently, the more affordable end has moved a little bit more. And that's just purely off the government grants.
Yeah.
If you can buy something with 5% grant and the stamp duty is waived, there's just so much demand for that market.
To close a 500K property is going to cost you, what, 27 grand to close it? Something
Correct.
like that?
Yeah. And then I know the rates just went up today.
Are they? Oh,
yeah.
You got me.
Yeah. No, I checked before I came in. But in saying that, if you're getting a small loan like that, 0.25 is not going to affect it too much. But if you're going out and buying this multi-million-dollar property, 0.25 will start to eat into your cash flow a little bit more. So I feel that cheaper market won't get affected as much moving forward. So to answer your question, yes, Melbourne, the affordability is okay, but the cash flow not so good. And that market's moving. It's moved since last year. The other market where I buy, which has similar kind of criterias in terms of that, is I'm buying old red brick units in Sydney. And I've actually been buying these for the last 3 years. Yeah, I know this. We're going to turn this off in a minute because I'm going to cry. So anyway, it's exciting. Yeah. And the funny thing is, I know that you did a podcast on Todd's show in terms of opportunities. Yes. And this is probably maybe 6 to 8 months ago that came out. I had a lot of tomatoes thrown at me in the comments on that one. Yeah. Like a lot of tomatoes, and I don't mind. I like, but yeah, I think what it boils down to, and I'm going to, because we're talking about Sydney unit, I think that's great. And I'm going to pick your brain on this in a second, but also Melbourne unit as well. There's a lot of value there. And the way I kind of look at it, and I was explaining this to a client a couple of days ago and saying this is kind of what I do. And if you've got the borrowing capacity, so if you take that 750,000 purchase, and I don't have a crystal ball, but I think there's a good chance over a nice property cycle that will double, but no one knows for sure. But one thing that we do know is before tax, if you're doing 100% lend on that, you're going to be down about 23, 24K. Yep. And so then if you kind of look at it, and if you did have the serviceability, and if you did pick up these Melbourne units, and you're looking at a 6.5 to 7% yield in some areas for a 2-bed, 1-bath. And so that's roughly on 100% lend down about 2 to 3,000 a year. So potentially you could buy, let's just say 10 to 12 of them. Let's keep the math easy, keep it 10. So that means you've got $4 million exposure at the same sort of like price point as a $750,000 house. Now, I'm getting old, and we was having a laugh just before the show about my wife. We want to take it a little bit easier. But if the cash flow is pretty good and I get that exposure up, I get brownie points. We're going to see some rental growth on that. But this kind of seems to be your Logan kind of play. Correct. Like people saying we've missed a boat, and I'm going to pepper you this in a second, but it's still out there if people really want to be a contrarian like Michael Xia. Correct. And then when I saw those numbers, I remember just kind of saying to my wife, I'm like, this is exactly what Logan was like a couple of years ago. If anything, I actually thought it was a bigger opportunity because it's in Sydney. And Sydney is a global city. I mean, it doesn't get much better than Sydney in terms of. No. So, and then to have this, I'm not saying that units are any better than houses in any way. That's not the message that I'm throwing across. And I have this conversation a lot. If you ask me and I'll put units versus houses in a vacuum, houses will always outperform units. Like that's a no-brainer. It's a land content that goes up. There's more land content when it comes to houses, so they'll outperform the unit. Yeah. But what we need to also then take into account is not all market cycles are in equal. So I'll give you this example. Houses in Sydney have done quite well over the last 4 or 5 years. They've had decent growth. Yeah. But it's impossible. I don't know, let's take Auburn, for example, because I know a client of yours recently purchased in Auburn and did quite well. Yeah. But let's do this example. Let's say the houses, $2 million in Auburn, goes from 2.5, goes to 3 million, 3.5. It's impossible for the house to keep increasing in value for the unit to stay at 450,000. Yeah. At one point, the gap's going to get so big that the units will have to play catch up. And we've seen other examples of this. Like if you go back recently, if you look at the townhouse unit growth in Perth, it's been phenomenal. And the one example that I like to give is, I don't want to kind of harp on about Logan, but just because I know the numbers, I'll kind of give this example. And this is like a story that I mentioned to a couple of other investors where going back to 10 years ago when I first started buying Logan, I told everyone, do not buy townhouses. Who in their right mind will buy a townhouse in Logan? The demographic for Logan is not for townhouses, so don't touch that product. 10 years ago, you could buy a house for 250 and a 2-bedroom house for 150,000.
Yeah.
In my mind, I'm like, why would you buy a townhouse? You spend 100K more and then you've got that house.
Yeah.
But fast forward 5, 6, 7 years, that house went from 250 to 600, 700,000. And that point in time, everyone looked at this townhouse, 150,000, but it rents out 500 per week. Those numbers look pretty good.
Yeah.
And in the space of in the last 2 to 3 years, that townhouse has gone from 150 to 500,000.
Yeah.
So in terms of net growth, it's actually outperformed the houses.
Yeah.
So it all just depends on what part of the cycle you're in. And in terms of the contrarian approach, in terms of if you look at the Sydney units, houses have continued to do quite well. Sydney units in the grand scheme of things in the last 5 to 10 years pretty much hasn't moved.
Yeah.
And if I speak to every client with Sydney properties, that's all their common gripe. Oh, my units haven't moved so much. Maybe I should look to sell it. But then my feedback is, that's similar to having a property in Brisbane. You bought in 2009, held until 2019. It wouldn't have done anything. Same in Perth from 2007 up until 2020.
Yeah.
That whole period, it wouldn't have done anything. And similar for Sydney units now. For the last 5 to 10 years, it's done nothing. But now you've gotten to the point where a couple of things. One, the 5% affordability is driving that market. 2, we've got so many migrants coming to the city. If a migrant comes to Sydney, are they buying that $2 to $3 million property? I'm sure there's a few wealthy migrants
Mostly
that are,
not. Yeah.
but then mostly they're not. But the main clincher for me, and it's also one that I look at very carefully, is look at the replacement cost for that unit.
Yeah.
You buy the land, you then pay for the construction, the materials. There is no way you're building this unit for 450,000.
Well, no, and a lot of these older sort of, red brick, orangey brick type, they're double brick. They're built like tanks. And to actually to replace one of those blocks is probably even double. And no one's going to do that.
Correct.
And so, and I think there's a precedent. I have to get this right. My team were looking at this, and I think there was a development proposed for Potts Point where they're going to knock down, I think it was an 80-unit building. And it looks like to put in 16 real luxury sort of units that we're going to overlook. But it's looking like that proposal going to get knocked back. And if that gets knocked back, then there's going to be a precedent there. And it's highly unlikely, like you're going to see kind of high rises replace these kind of lower, horrible red brick looking buildings type buildings. So if you get in there and the numbers make sense, they're going to stay and they're just going to grow because there's not going to be that much supply coming into these particular areas. So for me, I think they're absolute gold. And then even if you look at kind of more blue chip areas, you look at, say, a Campsie, for example, where the numbers might not stack up as much. But if you're going to come in as a migrant and you're going to want to be close, so you're going to get into the best area you can be, whether that be Ashfield, wherever it is, and then the prices are going to go up, and then you've got the classic ripple effect, and then all the other areas are going to change. If you're buying in Auburn at the moment, the unit you're talking about, we got that for 435. I mean, that's insane. That's cheaper than Perth, that's cheaper than Brisbane, and that's in Sydney.
Correct.
And yeah, a bit of a funny story here. Like when I probably shouldn't talk about this on a podcast, but I'm going to because I think it's quite funny. So one of the ways we've tried to look at gentrification plays is one of the guys on the team, he's single. And so he signed up to Tinder and they changed the location to Auburn just to sort of see what the demo, like who was in the sort of area. And what we were finding were a lot of young single women sort of moving out from the beaches to the likes of Auburn and other areas. And so like when you're sort of talking, we kind of like put in a couple of things like, I think they were pretty open about it at the end, but it was like, why do you want to come here? Like, why don't you go somewhere else? And it's like, well, to your point, first homeowner's grant, this is all I can afford. I can get onto the property ladder.
It's only 30 minutes to the city.
30 minutes to the city of Sydney, yeah. And so all of a sudden you're seeing, that's just one little thing. I mean, it's a bit of a laugh, but there you can actually see it changing in real time. And so if anything, it's like when you've got that period of stagnation like we've seen over the last 10 years, that's generally when, like you're saying about Brisbane, people just can't handle it anymore. They tap out just at the wrong time and then bang.
Correct. Yeah. And then it's like so many people hear that and the first thing is like, oh, I've just heard on so many podcasts or forums to say no to, units. Yeah. Units will never go up. But I think it's also then you need to look at in terms of the context, the time frames. And when something is bad for so long, eventually it will look good.
Yeah.
Yeah. Because at one point there'll be value in that asset class.
Yeah, no, absolutely. And when that yield starts checking up as well, that's obviously a hat tip to have a look at those and see what you can find. And obviously not all units are created equal. There's a lot more due diligence you need to do. to find out those ones, reading through the minutes, seeing what works need to be done. But again, that's no one said this is easy.
No. And then in terms of the yields, so that client of ours that bought that unit in Auburn, so that was 435.
435.
And my missus is a property manager for that one, and it got rented out on the first open home for $600 a week.
600. I mean, that's
is over 7% yield. 7% yield in Sydney.
Yeah,
that's insane.
Absolutely, there's good land content on that one. So shout out to Scott who bought that one. I was stoked. I actually spat out my cornflakes like when I saw that sort of email come through and sort of saw that yield. But there we go. Like we've had quite a few examples of that 6% yield. And like sometimes I'm reticent to come onto pods and talk about it because, and I know my team says please don't keep talking about the units because I mean there's such good opportunity. But at the end of the day, I want to help people. And so if you are a low income earner and you kind of want to get onto the market, if you're a first time buyer or want to get a PPOI and you don't want to do the rent vesting route, that's a bloody good opportunity. This is how I started. I bought my place in Kogarah, 440, and lived in there, and that set up my whole portfolio. And so there's many ways that you can rent vest, you can get onto the market,
100%,
and you do well. You get it, you pay down the mortgage, you can extract the equity out and build a portfolio. So there's great opportunity there. I think if we look at Melbourne units, we touched on that a little bit. So that's definitely more kind of contrarian and at the start, or probably not even at the bottom. Well, it is at the bottom. I mean, it's not moving up at all, but that's the time to buy.
And the other thing in terms of the markets too, I don't think anyone can pick the top or the bottom. Yeah. It's only when you move past that point and you're like, oh, actually, that was the bottom. So in terms of Australia Day last year, you wouldn't have known that for Melbourne. But now looking back in hindsight, then you can then see that. So I think when the numbers stack up and you don't have a lot of competition, and you can make deals work, that's probably the time to make it happen.
So that's where you get the best discounts and that's where you get the best deals. And then again, like going back just to Perth, I'll move this on in a second. Yep. But I remember when I said to people I was buying in Perth in 2021, everyone just laughed at me. Yep. And when they laugh at you, that's genuinely the time you know you're doing the right thing, actually. Because they're like, oh, no, well, you need to be on Brisbane. And Brisbane did fine after 21, don't get me wrong. It was still kind of like in the midst of it, but still the outsized gains, you want to buy right, contrarian when no one else is. But that's where the big gains are made at the start of the cycle. And that's kind of why I'm not looking at Perth for myself or clients anymore. If they want Perth, there's other people who can do that. I think there's maybe value in the unit still. Yep. But in the houses, I think it'll do well over the next couple of years. But for me, it's a little bit too, I think there's better opportunities out there.
Yeah, no, I'm aligned with you in that. I'm sure there's upside in Perth.
Yeah.
And again, no one can pick the top. So you could buy at this point in time, you could buy in Greenfields for, I think it's about 700 now, maybe a touch lower, but around 700,000. Yeah. Maybe it goes to 800, maybe it goes to 900. But in terms of the risk that you're taking for that bit of upside is a lot more than, say, for instance, buying something that's a lot lower in the cycle.
Yeah.
Yeah.
I mean, to go to your Greenfields, you're getting a 7% yield. So the same property now, if you're buying in Greenfields, you're probably looking at a 4.5% yield. Is that
correct? Yeah.
So to me, that already kind of says, where rates are so 6 point, whatever they are now, it's already a bit of a red flag when the market's moved so much.
Definitely.
Yeah. Right. So the one thing I wanted to do to you, do you remember, have you ever watched Men in Black?
Men in Black, yes.
Yeah, he's got that little tool, and basically, like, while that tool sort of wipes your memory and sort of you kind of don't remember the last few minutes. What I'm going to do to you, because I want to make this kind of like applicable. You've got so much knowledge, and you've been a key person influence, I reckon, in the property market and mortgage broking space. But I'm going to use that little device. I don't have it here, sorry. But rather than sort of wiping your mind, I'm going to wipe your sort of portfolio. But you've got all of those smarts, everything you've learned over the last 15 years of sort of toiling. I think it's even longer than that, actually. Sorry. Yeah. So I sell yourself short. But if I've done that now, you basically swearing at me. But it's the journey that's the fun bit anyway. Yep. So what are your first 5 steps? What are you going to do? And obviously you're an expert mortgage broker, so you've got an advantage here. But I think so many people get a lot of value because people always think they've missed the boat. We've obviously talked about opportunities, but now I've put one of Australia's best property investors. I've taken away all of his gold, like just for half an hour anyway. What are we doing?
I won't talk about, the generic stuff in terms of forming a team and so on and so forth, because I think that's been spoken about.
Yeah.
But what I will do is I'll go into kind of the theory behind it. I'll explain the theory because I think once you understand the theory in terms of all of this buy and hold investing, then I'll talk specifically in terms of what I would do. Then that will make a lot more sense.
Yeah.
So in terms of this whole journey, it's all about just holding a larger property base for a property cycle. And when that base doubles over a property cycle, which tends to be 7 to 10 years, that's where you see the fruits of your labor. So what I'm going to do is I'm going to note on this paper in terms of some numbers, and then hopefully you can then project it for the podcast.
Yeah.
And then we can chat through it. And I think once you see this, it's very simple, but I'll explain a couple of key points behind it. And I think there might be some aha moments.
Okay, that's brilliant. Yeah, let's get into it. You'll put this on the YouTube video. So
great.
Okay, how are we starting then?
So what I'm going to do is I'm going to put in terms of the value of the property. And the value, I just mean the entire property portfolio value. So I'm just going to keep it very simple.
Okay.
Let's say, for instance, you've got a $2.5 million property portfolio value.
Okay.
So let's say, for instance, that's 5 times $500,000 properties.
Okay.
Yep.
Yeah.
And your loan across the board is then going to be $2 million.
Cool.
The $2 million is just 80% of the 2.5. So you leveraged up to 80%.
Yeah.
So then just taking a very simple deduction there, your equity value there is 500,000. So what I'm really kind of painting there is, you know, you've taken a little bit of time, you've slowly built up your property portfolio value. And at the end of the accumulation phase, you've managed to get up to about 2.5 million. And that's not unlike the journey that I went down.
Yeah.
Yep. So that's kind of the scenario that I'm setting.
Cool. And then just to make it, so someone starting out, obviously building a 2.5 million, that could be done over a space of a few years, basically.
Several years.
Using grants or whatever. We just talked about a few examples where it's, 25 to 27K just to get onto the market.
Yep.
Using that and then using equity from that purchase to keep going. And then, roughly speaking, sort of earning household income about 100 grand or whatever.
Yep.
This is what you can do.
Correct. And in terms of the specific model of that, that's what the mortgage broker will do. So the mortgage broker will then look at your income, assets, liability position.
Cool.
These are the banks that then you could use, and then you'll kind of then go down that path.
Yeah.
And this is very generic. It's, can't be specific on every viewer.
Yeah.
But a lot of investors, if they took the time and had the growth in the properties and did it over a number of years, potentially could look something like this. And I'm not saying it's overnight, it will take time.
And a mortgage channel is something you can do. You can actually take the situation, a big fact find form, put that all out, and then you can actually put that sort of capacity. So if you take that sort of 2.5 million, I mean, there's different tiers of lenders in there, how you do it.
Correct.
Yeah.
So you would use, the tier 1 lenders first, second tier, third tier, and then build it out.
Yeah.
And it's not unlike the very first call that we did. This is exactly this.
A bit of insight. But this is kind of like, I was a fairly experienced property investor, but this was a real light bulb for a moment. And there's actually, I look at sort of 2 stages of my property investing journey. The first stage where I did okay, but I didn't really know what I was doing.
Yep.
And then this second stage where that was the light bulb moment where you put that map out. I think it was about 14 purchases for me. And I was a PAYG. I didn't have a business or anything. I was okay. I worked at some, big companies, but I wasn't earning, crap loads of money. And my wife wasn't working then either. But we scrapped and to the point whereby the whole thing I tried to do was to get to that sort of portfolio value that you were able to model out to me. I think it was about 7 million at the particular time. And we just pulled every single string. It's not easy. It's not supposed to be easy though.
No.
And that's what we did. And I think, if you like people who are listening to this, if your mortgage broker can't do this, you got to find another mortgage broker who can model this out. And I'm not just saying that to be facetious. Like you've got to think about what's best for you and your family and your own situation. And if your mortgage broker's not doing this and going, you can just buy, you've got borrowing capacity of 800,000, just go and buy a property 800,000. Well, how's that going to set you up for properties 2, 3, and 4? And how you're going to get to your goals. And that's kind of why that was a light bulb moment for me. And that meant I can just go, well, I'm going to buy that type of property, that type of property, that type. And it's all about how's the next one open up the next one. And that's absolute gold. So yeah.
Right. So we'll play it forward. So that's, you've managed to build a property portfolio.
Cool.
And we're going to play it forward.
Cool.
And historically, every 7 to 10 years, the property prices have doubled.
Yeah.
And then, you just think of in terms of Brisbane, Perth, you go back 7 years ago, property prices were half of what it is today.
Yeah.
Melbourne, you go back 7 years ago, a little bit lower, fairly similar.
Yeah.
Sydney units, you go back 7 years ago, pretty much the same.
Yeah.
So those markets haven't grown. So you're hoping that you buy then you don't need to wait another 4, 7 years for it to do its thing. So then hopefully you've saved yourself some time.
Cool.
But let's hypothetically say the property prices double.
Yeah.
Your value then becomes 5 million.
Nice.
Your 2.5 doubles to 5 million. Your loan, let's say it stays at 2 million. let's hypothetically say you've stayed interest only for that entire 10 years. It stayed at 2 million. You haven't paid it down. In reality, it's probably going to be a little bit lower than that because you would have paid some of it off. But I'm just going to keep it high at 2 million.
Yeah.
Then I'm going to take a really simple example. I'm not going to take tax into consideration. There will be taxes. But let's say, for instance, at the end of that 10 years, you're like, Steve, I'm sick of these properties. I've got too many tenant issues. I'm done. I want to sell all of these properties. You sell off these properties, 5 million, you clear out the 2 million, and then you're left with 3 million.
Not bad.
And then a lot of people, their goal in terms of going down this path is all about recurring income, not having to be then stuck in terms of their day job to be earning a source of income.
Yeah.
Then take that 3 million and put it in something that give you 5% return. 5% return at the moment is fairly doable, especially with the rates going back up. It'll be even a bit easier.
Yeah.
But 5% return on 3 million every year, that's a recurring income of 150,000.
There you go.
Now, for some others, their goal is to buy a dream home. So great, you've got these properties. Maybe you don't need to sell all of it. You sell off a couple and that's going to be your deposit then for your future home. Or in reality, you're not going to go down this path and sell off every single one. Maybe you sell off a couple, you use that to then clear away the debt. And then that recurring income will be then very similar to this amount.
Yeah, and I think the key thing, you just got options. You've got that. If you wanted the dream PPO, it's obviously going to be different per person. But yeah, whether it's a term deposit, like paying down rent, or even then trying to catch you up, you've got those options to keep going. Obviously, then to go to the next level, there's other sort of factors that come into it, like how much you earn, etc. As you've told me many times.
Yeah.
But no, this is simple. It's something that's achievable now for most people listening to this. And so if you're thinking about it, I've missed a boat, well, here you go. You can still do this. And we just talked about a few assets that where you can still get in and construct that portfolio.
Now, in terms of some key things here that I'll highlight, kind of running through these numbers, and initially you first missed this, potentially, is one of the key things in terms of what you gain from a property cycle is your base. So say, for instance, you have a $2.5 million property portfolio and it doubles. You stand to gain $2.5 million. So the whole goal in this is actually to hold a bigger base. Because if I can hold a $5 million property portfolio as opposed to a 2.5, then I stand to gain a little bit more.
Yeah.
So this game is not really about, does this property have better capital growth? It's more so, can I add that property into my portfolio and does it allow me to then hold a bigger property portfolio? So that's why, looking back, the path that I went down when I was buying these properties that were a lot easier to hold, the key thing that it allowed me to do is to hold a bigger base. So say, for instance, if you went out and bought 10 Logan properties, holding them wouldn't be too difficult because they were paying for themselves. 10 properties, 300 a pop, that's 3 million. On the flip side, if back then I went and bought, say, a blue chip property with 3% rental return, to hold an equivalent of that for $3 million, but on blue chip will be a lot harder. Because you can't hold the 3 million, then you would buy fewer properties, have a smaller base. Then over that property cycle, it won't then double as much. So the key thing is actually, what can you buy to then hold a bigger base? So if I do have a choice, I always lean on properties that give a slightly better rental return because that also allows you to hold a bigger base.
And it's so important. I mean, on paper, you're talking about the blue chip method, like the $3 million portfolio. And if you think you can hold that negative sort of cash flow, think again, because when you live through it, it's very different to sort of thinking, I can handle that. I mean,
correct.
It's something I've seen. And for me, for most, probably 90% of people, that's a generalization. This makes a lot more sense. It's so much easier, much more easier conversations around a dinner table where it's not moaning about problems where X amount is coming out the portfolio. This is something that's really simple, could be implemented by most people, and a lot of people have done it. So
correct. And all I'm saying in terms of this realization, I actually remember vividly to a conversation where I had with a lady from Property Chats at Summersoft, who I'm named Skater. And it was in Parramatta at the Bavarian Cafe. And I vividly remember this conversation because very early on, and that theory kind of got implanted in my head, because I battled with this question early on. And I remember asking Skater, where if you say, for instance, looked at the investors that you've seen through your journey being on Property Chat, the ones that have made it through buying properties with better capital growth, but slightly worse rental return, or properties with higher rental return, but maybe slightly less growth, which of those over the last 20, 30 years have you seen do well? Because she's a lot more experienced and seen far more cycles than I have. And her answer was far more on buying properties with better rental return.
Yeah.
And I was like, oh, why is that? And she goes, because over the last 20, 30 years, the ones that purely focused on capital growth got wiped out at one point in time or not, or were forced to sell.
I mean, it's a good point you make. And I think surrounding yourself, you're talking about, and we have to kind of sort of go over because we haven't got so much time.
Yep.
But you're talking about building a good team. It is so important. But also surrounding yourself with like-minded people who've actually got the runs on the board and who've done it. And that's kind of why Somersoft was so good, and Property Chat and individuals like where you can actually learn, and then you can see, well, if they've done it, it's just a case of replicating what they've done, and you don't need to reinvent the wheel 100%. At all here. I've never really kind of subscribed to, within the 10K radius of the CBD, get the best asset you can get and then have a 2% yield and then hope for the best. I think it's some people can do it, but the people who've managed to do that have got big businesses to sort of back that up, and then they can't afford to sort of carry that negative cash flow. For most of us mere mortals, is very different.
Correct. I mean, of course I would like to buy in blue chip. And, if in the grand scheme of things, compared to when I first started buying, I'm tending to buy a little bit more in those areas compared to when I first started. It's only because I can hold that. But if I had to start again, I wouldn't be buying something with 2 or 3% because that would just crush your progress in terms of moving forward.
Yeah.
So in terms of that, yes, I do think Melbourne will do really well. And if you can hold it and you are okay with the negative cash flow, I think that's a great play.
Yeah.
On the other flip side, if I'm just starting out, I don't have a lot of servicing, I'm struggling to come up with that deposit, I would much rather buy something that's a little bit more affordable with better rental return, like an old red brick Sydney unit.
Yeah. Yeah.
So that's one. Now, the second key point in terms of this number that misses at first is this whole game that everyone is playing. It's actually a game around inflation.
Yeah.
So I'm going to ask you this question. Let's say you owe the banks today $2 million. It's 2026 and you owe the banks $2 million.
Yeah. Yeah.
$2 million for someone starting out, a huge amount of money to be owing the banks. You just think about it, or you tell your friends and family and they'll be like, you're out of your mind.
Yeah. Yeah.
Now, I'm going to pose this question. Let's say we fast forward 10 years, it's 2036. You log into your internet banking and the same $2 million is staring back at you. Do you think in real money terms, is it worth more or less than what it is worth today?
It's obviously less. Like, I mean, you can see that in property prices, but you're kind of devaluing the debt essentially, and everything that's going on in the world, just the inflation numbers that we've seen. That's why rates going up, but that's exactly it. And then when you look at the property prices, when you go back to 2010, I mean, this is a little thing I talk to clients about a little bit. I mean, talking about Somersoft, I'm giving them a big rep, but I used to love the Jan Summers book. One of the things I used to love about Jan Summers' book, the first edition, she did the modeling on the first five properties and now 150,000. Then the second edition, she almost apologized and she goes, "Oh no, we've got to do it. We've got to do it properly now. It's 250,000."
Yeah.
And so and there's been no more editions of the book. You just imagine.
Correct.
And now it's going to be what in Sydney, what's the median? 1.4, 1.5, and it's like, well, maybe it doesn't work as much, but no. So 10 years, 2036, that debt's going to be devalued. Exactly. And the property, I mean, no one knows, but it's a good bet that, we're going to be seeing 5 million on this.
And then the examples that I give is like two ones that I remember vividly. So the first one is, going back more than 30 years ago, my parents came to Australia from China.
Yeah.
And they bought a 2-bedroom unit in Sydney in Eastwood. And I remember as a 7-year-old kid hearing my parents talk at night and also just having arguments going, how are we going to pay off this $100,000 loan on this unit?
Yeah.
Because 30 plus years ago, 100,000 would have seemed like the world to them.
Yeah.
But let's say you didn't end up paying off that debt and you had it today, you'll feel financially free from 100,000. And to your point, it's because the money has been eroded away.
Yeah.
Now, the flip side of that, if we then say, for instance, just use everyday life example, now you go out for lunch, how much is like a bowl of ramen or a bowl of pho? It's like $25.
Yeah.
Easy.
Yeah.
Easy. Yeah.
Yeah.
Before COVID, 4 or 5 years ago, that same bowl of ramen was only about $12.
Yeah. Yeah.
And, very soon we'll go out for coffee and coffee will be $8.
Yeah.
So why that is the case is because the fiat currency is constantly getting eroded. Every time they print money, they're eroding the true value of the fiat currency.
Yeah.
That's why across the board, if you look at all the asset classes, a lot of them are doing very, very well. Gold, I mean, prior to last week's crash, was at an all-time high.
Yeah.
Bitcoin, it's still doing very, very good. Property prices doing good. Shares doing good.
Yeah.
And the reason for that is because they're printing all this money, the money needs to find a place somewhere.
Yeah. Yeah.
And the other way that I reflect on it too, and I saw a meme of this recently on Facebook, is they said 30, 40 years ago, you could buy this house in Sydney for this block of gold. You could trade the block of gold for that house. 30, 40 years later, that house you can buy with that exact same block of gold. So the value of the house hasn't changed. It's denominated by the block of gold.
Yeah.
But what's changed, if you look at the property prices, it looks like, oh, this property has gone up so much. But in reality, the house value hasn't changed. All that's happened is the fiat currency has been eroded away so much.
Yeah.
So that's why in this game, if you then can play inflation to your advantage, the debt gets ridden away, your assets keep up with inflation, and it's that spread that makes the money.
Yeah.
And that's all it is. It's just a game of inflation. And if you don't look at it just from a purely personal example, if you look at the governments in this world, how are they trying to pay off their debt? They're not trying to physically paying it down. They're printing more money to erode the debt away.
Yeah. Yeah.
So if they're doing that, why would you not want to do anything else?
No, absolutely. And there's a lot of gold in what you just said. You like that pun there. But in all seriousness, you're going to see that sort of gap. And it's been talked about by a lot of commentators out there, a bit of wealth divide, those who own assets and then those who don't. And it's an unfortunate thing, but you do, if you're thinking like property, and there's a lot of rhetoric out there on sites and style property's too expensive. My children are never getting on the property ladder. We just like detailed out, you can buy a property for 20, 25, 27 grand, even cheaper in Melbourne.
Yep.
So you can do it. And like the quicker you do this, the quicker you're going to have the options in 10 years, whether that is to buy the dream PPOR, whether it is to go put in a term deposit, whatever you want to do, it's going to give you the options. And I think, that's why it's so good to have someone like, this is kind of relatable to a lot of people. Someone can go out and do this now. And in fact, I'm going to actually just move to that now. So if people are listening to this pod and we're putting out a lot of value, and it's so good picking your brain because there's so much to offer here. But first things, if someone's thinking, okay, I'm pumped now, I want to get into this, what's the first steps that they should do to start making this a reality?
I would say do more research, listen to my podcast. And then if you want this modeled out like this, then just reach out to Mortgage Channel.
Yeah, and to reach out to Mortgage Channel, how can people get a hold of you? I won't give out your personal number.
Sure, no. So best is just through mortgagechannel.com.au through the website, or can email michael@mortgagechannel.com.au.
That's awesome. Yeah, no, and many happy clients and myself very happy, obviously, with your service. I mean, like the mapping out, as I said, it was a light bulb moment that's changed myself. So reach out to Michael and he'll be able to help you. But like, one thing I've got to ask you, sort of like over the last 10 years, you've accomplished so much, like you were just saying yourself, like you wouldn't have managed your portfolio value is going to be this much and have over 100 properties. So my question is, you just asked about 2036. What's next for Michael Xia and Joe? Like, where do you go from here?
I actually pose that question to myself every day. It's like, but I think in terms of human nature, like one saying that I really like is like, if you're not growing, you're dying. So I think it's whatever that you do, you need to have a sense of purpose. And be it purpose in building your property portfolio, be it purpose in building the mortgage broking business or whatever it is, it's as long as you wake up and you have a skip in your step, and that's a purpose for waking up, that's what I strive for. Yeah. If it comes to a point in time where I'm like, actually that doesn't interest me, then I'll find something else. So yeah, indeed. And you've got a young family now, so that's going to change things a little bit. So correct. So at the moment, the motivation's still there, passion's still there. You're helping so many Australians as well. That's got to give a massive sort of like thing. So that's great. But no, I just thank you for coming in. Thank you for sharing. I'm going to get this. We'll put this on the schematic. I've got a lot out of this. Any parting words or? No, I'm looking forward to your journey unfold even more.
Yeah. Now we've got to do a big refinance soon, so I'm looking forward to getting all the documents across to you. But we're looking to go and people I've spoken a lot about on the pod. My idea is I'm at a phase in my life where I'm looking more cash flow. I'm going that real contrarian route where I'm going to try and buy as many units as possible. If I can get unit blocks, I'll get them. But if I can't, I've got no problem buying individual units because the deal stacks up. And we're going to try and get that portfolio value up as much as we can. Because to your point about the debasement really of currency and the currency not being worth anything, we do know in 10 years' time, if I can get that portfolio value up close to that 20 mil mark, which I think is very doable for us now. And I know that's not relatable to a lot of people, but we have fought blood, sweat and tears to get out this way. And we have done this mostly by doing PAYG. I'll do that. And then we'll be sitting even prettier there. And then it might be time to get back on the golf course again, because I certainly can't. I'm certainly not doing very well on golf at the moment. But anyway, I love this and I love helping people. But no, thanks ever so much for coming in. I've got so much out of this. I'm sure a lot of people will as well. So thank you, Michael.
Cool. Thanks for having me.
Thank you.